Investing can be a confusing and daunting task, especially for those who are new to the stock market. But what if there was a simple strategy that could help you outperform 99% of other investors? This is exactly what Peter Lynch, one of the most successful investors of all time, offers. Peter Lynch is best known for managing the Fidelity Magellan Fund from 1977 to 1990. Under his leadership, the fund's assets grew from $18 million to an astonishing $14 billion. Lynch achieved an average annual return of 29%, making him a legend in the investment world. His success was not based on complex theories or insider knowledge, but on a straightforward approach that anyone can follow. In this video, we will explore Peter Lynch's simple yet powerful investment strategy. By understanding and using Lynch's strategy, you too can aim to achieve exceptional returns and make smarter investment decisions. So, let's dive in and learn how to invest like Peter Lynch. Peter Lynch was born in 1944 in Newton, Massachusetts. He developed an interest in the stock market at a young age, inspired by his work as a caddy at a local golf club. This job allowed him to listen to successful business people talk about investments, sparking his curiosity. Lynch attended Boston College, where he studied finance and worked various jobs to pay his tuition. After graduating, he earned an MBA from the Wharton School at the University of Pennsylvania. His big break came when he joined Fidelity Investments as an intern. In 1977, he became the manager of the Fidelity Magellan Fund. Under Lynch's leadership, the Magellan Fund experienced phenomenal growth. He managed the fund from 1977 to 1990, during which time it became the best-performing mutual fund in the world. Lynch's strategy was simple: invest in what you know. He believed that individual investors could find great investment opportunities by looking at everyday products and services they used. Lynch's success was not just about picking the right stocks, it was also about thorough research. He was known for his diligent work ethic, often visiting companies and talking to their managers to understand their business better. This hands-on approach helped him make informed decisions and avoid common investment pitfalls. Understanding the strategy. Peter Lynch's investment strategy is famous for its simplicity and effectiveness. At its core, his approach is based on a few key principles that anyone can follow. First, Lynch believed in the idea of buy what you know. This means investing in companies whose products or services you use and understand. For example, if you notice a new restaurant chain that always has long lines, it might be worth looking into its stock. Lynch thought that everyday observations could lead to great investment opportunities. Second, Lynch emphasized the importance of doing your homework. This means thoroughly researching a company before investing in it. Look at the company's financial health, management team, and growth potential. Lynch often visited companies, talked to their managers, and read financial reports to get a deep understanding of their business. Another key principle is to look for companies with strong growth potential. Lynch liked to invest in companies that were growing quickly but were still relatively unknown to most investors. These growth stocks can offer high returns if they continue to expand. Lynch also focused on a company's price-to-earnings (P/E) ratio, which is a measure of how much investors are willing to pay for each dollar of earnings. A low P/E ratio might indicate that a stock is undervalued, while a high P/E ratio could suggest that it is overpriced. However, Lynch didn't rely on this metric alone. He considered it as part of a broader analysis of a company's potential. Finally, Lynch believed in being patient and staying invested for the long term. He argued that trying to time the market or make quick profits often leads to poor results. Instead, he advised holding on to good investments and allowing them to grow over time. Practical application. Applying Peter Lynch's strategy in your own investments is simpler than you might think. Here's a step-by-step guide to help you get started. Step 1. Identify opportunities. Start by looking around you. Pay attention to the products and services you use every day. Are there any new brands or businesses that seem to be gaining popularity? For example, if you notice a new coffee shop that's always busy or a new tech gadget everyone is talking about, these could be potential investment opportunities. Step 2. Do your research. Once you've identified a potential company, it's time to do your homework. Begin by checking the company's website and reading their annual reports. Look for information about their products, services, and future plans. You should also read news articles and analyst reports to get a broader perspective on the company's performance and industry trends. Step 3. Analyze the company. To evaluate a company's potential, consider several factors. Financial health. Look at the company's revenue, profit margins, and debt levels. A healthy company should have growing revenues and manageable debt. Growth potential. Assess whether the company is in a growing industry and if it has room to expand. For example, a company in the tech sector might have more growth potential than one in a declining industry. Management team. Check the experience and track record of the company's leaders. Strong leadership is crucial for long-term success. Competitive advantage. Determine what sets the company apart from its competitors. This could be a unique product, a strong brand, or superior customer service. Step 4. Evaluate the stock. Look at the stock's price to earnings, P/E, ratio to gauge its value. Compare this with other companies in the same industry. Remember, a lower P/E ratio might indicate a good buy, but it's just one part of the puzzle. Step 5. Invest for the long term. Once you've done your research and analysis, invest in the company with the intention of holding it for the long term. This means being patient and not getting discouraged by short-term market fluctuations. By following these steps, you can apply Peter Lynch's strategy to find and invest in promising companies, potentially achieving great returns over time. To see how Peter Lynch's strategy works in real life, let's look at some of his famous investments and how his principles can be applied today. One of Lynch's well-known investments was in the retailer The Limited. Lynch noticed the popularity of its stores and did his research. He found that the company had strong growth potential and a good management team. As a result, his investment paid off as the company grew rapidly. Another example is Dunkin' Donuts. Lynch observed the brand's growing presence and did his homework. He discovered that Dunkin' Donuts had a solid business model and excellent profit margins. His investment in the company proved to be very successful. Modern-day applications. Today, Lynch's strategy can still be used to identify great investments. For instance, consider Tesla. Many people notice Tesla's innovative electric cars and increasing popularity. Those who researched the company found strong growth potential and a visionary leader in Elon Musk. Early investors who followed Lynch's principles saw significant returns as Tesla became a major player in the automotive industry. Another example is Netflix. Observant investors noticed the growing trend of streaming services. By researching Netflix, they found a company with strong growth prospects and a unique competitive advantage. This led to high returns for early investors. Overcoming challenges. Investing can be challenging, but Peter Lynch's strategy helps overcome common obstacles. Here are some tips to navigate these challenges successfully. Common pitfalls. One common mistake investors make is chasing hot stocks. Just because a stock is popular doesn't mean it's a good investment. Lynch advised against following the crowd. Instead, focus on companies you understand and have researched thoroughly. Another pitfall is panic selling. Markets can be volatile, and prices may drop suddenly. Lynch believed in staying calm and holding on to good investments. Selling in a panic often leads to losses. It's important to stay focused on the long-term potential of your investments. Staying disciplined. Discipline is crucial in investing. Lynch emphasized the need to stick to your research and not be swayed by market hype. Set clear investment goals and follow your strategy, even when the market is unpredictable. Patience is key. Allow your investments time to grow and avoid making impulsive decisions based on short-term market movements. Adapting to change. Markets and industries change over time. Lynch's strategy involves keeping an eye on these changes and adjusting your investments accordingly. If a company you invested in starts to show signs of trouble or if a new opportunity arises, be prepared to reevaluate your portfolio. Continuous learning and staying informed about market trends will help you adapt and make better investment decisions. These principles will help you navigate the challenges of investing and increase your chances of achieving long-term success. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.